Good morning and good afternoon, everyone, and Happy New Year. This is Jim and Anna with Live with Jim and Anna. How are you, Jim, today?
I'm doing pretty good. I'm up here in Pittsburgh, near Pittsburgh, Pennsylvania. A little snowy, a little cold, but a lot of the country's the same way, so I'm not complaining. And the sun is out, so it's a great day.
Okay, well, I have no weather report here in Northern California, so we'll just move on to the questions then.
Works for me. Why don't I ask you a question, Anna? I just started renting out my condo. Can I write off HOA fees and improvements to the unit on my federal taxes?
Sure, Jim. Let me start with an answer. You can write off your rental expenses, but it's not going to be a deduction that you take right away. So let me clarify what I mean by that. HOA fees you can write off, including maintenance, landscaping, advertising, and also if you have a property manager, those expenses all can be grouped in together, and can be a deduction on your tax return. However, improvements such as new roof, if you had a remodel done in the kitchen, or updates in the bathroom, those kinds of expenditures are going to be depreciated over time. So it's not going to be a deduction in particular year where where you have that expense. You have to stretch it out over several number of years. One of
Okay.
the resource that we frequently recommend to utilize is either your tax preparer or certified accountant who can actually help you figure out, when and how you can deduct those kinds of expenses. And also, there are plenty of books out there, and I'm sure there are blogs that would give you more information on those kinds of questions.
Thank you, Anna. That is really interesting. And I know that as a real estate landlord myself, I have a nolo.com book on everything you need to know to be a landlord. So that's one of my reference tools.
Great. Okay.
How about a question for me?
Oh, a question for you. So let's see. I do have a question for you. Okay. At what age is my wife eligible to start taking one half of my Social Security once I reach full retirement age, which is 67? So she's 62 now. Does she have to wait until 66?
Well, Anna, that's an interesting question. And it all depends on who has got the biggest work benefit, number one. And number two, who's older and younger. In this case, the client writing in is older than his wife, the spouse, but there are special rules for spouse benefits. The other spouse has to be either on benefits or they have to file and suspend at their full retirement age or later. In the case of the writer, his full retirement age is 67. So he could go on benefits, and then his wife would be eligible for spousal benefits, but she may not get them because if her work benefit is bigger and she's under her full retirement age, she doesn't have an option. So if she applied at 62 or 63, the Social Security Administration would figure out which benefit is better, her work benefit or one half of her husband's full retirement age benefit, and in this case that is age 67. Some baby boomers who are older, their full retirement age benefit is age 66, and there's some people in transition in between. So my advice in this particular case was for my client who would be age 70 before his wife reached 67. He would just go delay his work benefits until age 70, and then when his wife was 67, she would go in and apply for spousal benefits, and then she would have a choice. And she could delay her work benefit to age 72. And this is one of the most beneficial strategies. It's not the only one, but it's one of the most beneficial and a very common strategy because that larger age 70 benefit means that your cost of living adjustments are going to be larger. And if you live past 81 or 82, you're actually going to end up with much more money from Social Security. How's that?
That's a good answer. And I think you were talking about doing starting your Social Security webinars pretty soon. So be on the lookout for announcements. That's where you can get more information on these kinds of questions and actually more details and more scenarios where you can figure out what makes more sense, right?
And traditionally, we've done that on the last Sunday evening of the month. And in January, we'll be announcing that, and it should be the last Sunday evening of the month up until summertime.
Okay, sounds good. One little housekeeping announcement. Now we have a couple of viewers. If you guys have questions for us, follow-up questions or new questions, and you're watching this live, right on the screen that you're looking at, on the left-hand side at the bottom, there's a little button that says join in the conversation. So that's where you can submit a question. So we're going to go on to answer a couple more questions, but in the meantime, if you want to ask something, this is your chance.
And I would add that Anna is really excited about answering your questions, especially really difficult ones. So don't forget to add those in. But let me ask you an easier question, Anna. Are there any tax law changes for 2015?
Jim, I'm not going to say it's a good question, but how did you know to ask?
Because you told me to, Anna.
All right. Why did you give away my secret? Okay. As it turns out, I actually attended a session yesterday at the Financial Planning Association monthly meeting on the tax updates. And then this morning, there was a tweet of an article that has actually a lot larger summary of what tax law changes there are in 2015. But I'm going to cover a couple that kind of stood out to me, and I thought they were going to be more applicable to the kinds of clients we have. So number one is flexible spending account. So as you remember in 2013, traditionally flexible spending accounts, and those are the accounts that you have through your employer where you can put pre-tax dollars to pay for healthcare expenses, tenant care expenses, transportation costs. So that's just additional kind of benefits you get as an employer. So in 2013, there was a new rule that came out which allowed the funds that you accumulated in FSA accounts to roll over into the next calendar year, because previously that was more of a use it or lose it in that calendar year.
Correct.
Now, that was great because a lot of times you didn't get a chance to spend all of your FSA dollars. But guess what? This year there's another change to this account. So here's how it works out. You can still contribute to an FSA account, and you are still allowed to roll over up to $500 into the next calendar year. So the difference is if you do roll over the $500 in your account and you keep it there, let's say into the 2015, you will not be eligible to contribute into that account in 2015. Okay? So let's say you had a balance that you wanted to carry over, and because you didn't want to lose that, so then you will not be able to make any more additional contributions in 2015. So you have to kind of make a decision whether it's worth for you to lose whatever the balance is there and start new contributions, because you get deductions on those contributions for 2015. Now, this particular rule only applies to the general use of flexible spending dollars in that account, so it does not apply to health savings. So if you're using FSA dollars for health savings, that doesn't apply, and also dependent care. Okay, so if you're using those savings, for example, for transportation costs, that's where it could be a little tricky. Okay.
That does sound tricky. Question.
Yes,
if I wanted to read more about it, where do you think I should go?
Okay, so if you follow me on Twitter, I mentioned this already. I tweeted, there was an article this morning from Monthly Fool that gave a detailed description of all of these new changes for 2015, so you can read it there. You can also Google.
What is your tweet?
My tweet handle is A and then my last name. So ASERGUNINA.
And that's right below your face there.
Exactly. So.
Okay, so we can spell.
If you just Google my name, the Twitter will come up. And now, if you just want to email me, I'm happy to send you a link to the article. Can I cover two more?
Yes, go ahead. Sorry.
Okay. All right. So number two that was interesting to me is unemployment benefits. Now, we know being unemployed is already stressful enough. So what adds a little bit more to that is that the unemployment benefits are now going to be taxable income. So in the past, they were not. So you're going to be getting a W-2 or 1099-G form in the mail, and you have to include these benefits as part of your income for 2015. All of these changes, again, just to make sure I'm not confusing anyone, they're for 2015, although we still have to complete tax return for 2014. Now, my last one, and I particularly like this one because the speaker yesterday at our session mentioned this too. There's a little bit more money now is allocated towards mileage reimbursement. So, Jim, pay attention because you have to submit your mileage reports to me. So, in 2015, the miles which are driven for business-related activities, the reimbursement rate is 57.5 cents. Okay, it's half a cent more from last year. It's 23 cents for miles that are driven for medical or moving purposes, and 14 cents for miles that are driven for charitable organization kind of activities. Now, what the speaker said at the session yesterday is that everybody was so excited, or has been excited in the last few weeks about the gas prices, right? So the IRS is not stupid, right? So they're going to figure out that since the gas prices are so cheap, why do we have to allow, our taxpayers to use such high numbers for these miles that to reimburse themselves? So what this person, the speaker, believes is that these rates are subject to change in the middle of the year. So you have to really keep good track of your miles. So it might be getting less after July 31st or June 30th.
Thank you, Anna. I remember a number of years ago when oil and gas prices were very low, I was making a profit on my mileage reimbursement for the bank I worked for. Unfortunately, they weren't stupid either, and they cut our allowance. So
there you go.
So they're in collusion with the IRS.
Yeah. So, well, use it while you can, but be on the lookout for that. Okay. Well, I think it's enough on the tax updates. Now, can I ask you a question, Jim?
Go right ahead, Anna. Do you have a good question for me?
I have a hard question for you. How about that?
Uh-oh.
Well, let's see. Okay. My wife and I just had our first baby, and we decided that she will stay home with the baby. Our biggest obstacle is dealing with the student loans. Would it make sense to file a separate tax return so that we can qualify for income-based repayment plan for these student loans?
Right. Married filing separately is a category that is not very conducive to saving on taxes, except in a case where there's a large disparity between one party's income and the other party's income if they're married. So, first of all, I said congratulations to our client, who are now parents, and I alerted them to the fact that this question is one of those that fits into the category of it depends. What I usually do in our business, and what I recommend other people do, is go to one of the two major online tax preparation websites where they have calculators that you can use, and usually there's a tab that says calculator, and they can enter their income both ways, married filing jointly and married filing separately, and see how the taxes are different. What happens, though, is many of the things that you get as exemptions and deductions do not apply to married filing separately. So unless those loan payments are dramatically cheaper because they qualify for income-based reduction, usually it doesn't pay off to do it. And they also need to know that if they pay reduced loan payments, that the interest is compounding and the balance is actually growing. So a lot of people forget that. They just want to get a lower payment, which is good, but holy cow, your balance is going to increase, and at some time you may not qualify for an income reduced payment, and then you'll have a lot larger balance to pay off. So I'm not really for it, but it's easy to go online and make calculations and see how it applies to you. There you
Do,
go.
do you remember which sites are the ones that have a calculator?
Yes, tax cut and TurboTax.
Taxcut.com and TurboTax.com. Right. I wanted to see what your second one was. I know the TurboTax. All right, Jim. Well,
One's
very
owned by
good.
Intuit, the other one's owned by H&R Block.
Right. And if you have a tax preparer or an accountant, I'm sure they can run a simulated tax return for you to let you know.
They
Okay.
can.
Well, it doesn't look like we have any questions that came through.
Well, you dodged another bullet then, Anna.
We'll have to wait until next month to
Okay.
see if somebody wants to ask us a question live. But we'll check and see if there are any comments after this video is posted, and we'll follow up with you guys. So I guess we'll wrap it up for today, right? It's Saturday, and I'm gonna go on and have my cup of coffee and.
And Anna, I wanted to apologize for delaying a day. We had a family situation where it was a sad situation, and so we had to delay a day. And I hope people aren't put off because we had to change at the last minute. It was an emergency. So
I hope so too.
okay. Anyway, thank you.
Bye, everyone. Take happy weekend. Bye.